This channel's old enough where you've seen a couple of one baggers and two baggers and a whole slew of securities that went up maybe 20, 30%. But the question is, how do you find these securities that have the potential of increasing substantially over time? And so that's what I want to talk about in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now, if you search in the value investing YouTube space, all you see is videos with thumbnails of this stock is going to 5x, this stock is going to 10x, or, more of the value investors will say this is a one bagger, this is a two bagger, three bagger, etc. It's essentially saying the same thing. Everybody's looking for these securities or the security or a group of securities that are going to jump substantially and quickly as well. And so, I guess one of the first things that you have to really think about is, what are you really trying to do? And I would say that if you're looking for stocks that are going to knock it out of the park, you might inevitably end up taking on too much risk. So I wouldn't say that you would want to specifically go out there and look for 1, 2, 3, or 4 bagger securities or those 10 bagger securities. What I would more steer you to do, and what you've seen me do on this channel over and over and over again throughout the couple of years that I've been on YouTube, is look for themes. And so let's talk about this whole theme perspective. And so in order to do that, let's start with the companies that have done the best on the S&P 500 over the past 52 weeks. So you can see this 1 year chart here. This is actually available to the Patreons in the tracker. You can actually go into the second and third tabs, and you have the 52-week highs and the 52-week lows of the S&P 500. And so you can see that, NVIDIA did the best over the last 52 weeks. They're up 214%. So there's your two bagger. But notice that there's a theme emerging from these securities. So you can see, and there's potentially multiple themes, right? You got some technology themes, etc. You got some travel, but notice the ones that I've highlighted. There's a very interesting theme here, and it's that home builders really outperformed over the past year. And there was really only one value investor YouTuber who was really shouting about them over the past couple of years, and that was yours truly. And of course, you can see that although those names did well on a year-to-date basis, you can see that there's one name that, significantly stands above the names that were on the S&P 500 list that you just saw. Look at Dreamfinders Homes. This was one that I was talking about for a couple of years now. It took a little while for the thesis to play out, but it turned into effectively a two bagger. So the question I have for you is, how do you get to determining which stocks are going to be on that 52-week high list before they actually get there? And you know what? The easy answer is start with the 52-week low list. So here is the 52-week low list. And it might be a little bit tough to view because I've blown it out to so many securities. But look, the point here is to not specifically find securities. So this is the trick. This is the money point right here. The trick is to not look for stocks on this list because you're just limited to the S&P 500. And I just showed you that how potentially companies that are not on the S&P 500 but follow the thesis could actually outperform. So the thesis that I noticed in the year prior was that home builders were very cheap and that people were going to continue to be building homes and people are going to continue to be buying homes, and there was a housing shortage in the country. That was the thesis that I determined based on looking at the 52-week low list. Now, if we look at the 52-week low list now, once again, the trick is to not look for stocks on this list, rather look for themes, because the ultimate stock that you choose may not even be in the S&P 500. And so what is the theme that comes out to you from just looking at these names? Well, 7 out of the 43 names that I'm displaying for you right here are regional banks. So 16% of the S&P 500 weekly lows as of September 10th, 2023 are regional banks. So there's a theme emerging here. And you guys already know the story. The story is that there is a challenging environment in the banking space because there's heightened risk for potential defaults with the office real estate properties. There is a net interest margin compression issue that's happening right now. And so the question that I would have for you is, how do you determine which are the right opportunities to pursue? Specifically, how do you determine which is the right bank to buy? And you know what? The answer isn't easy, but this is the next step of that whole thesis analysis. So first, you determine a trend. There's a trend right now of regional banks showing up on the worst performing securities of the past 52 weeks. Okay, fine. Now the question is, can we identify which banks' shares have overcorrected because there is a pervasive fear over the whole industry? Well, unfortunately, banks are very difficult to analyze. However, if you can do the work, if you have time to do the work, I think you can outperform here, because I think a lot of value investors are just staying away from this space because it's too hard to deal with. And so, although no two banks are exactly the same, what you can do is compare many of these regional banks against one another using various performance metrics, so key performance indicators. And so what I did was I dove into all of their financials, the financials of 63 different banks, and I pulled out their 5-year averages for 11 metrics, which I deem are important. And then I determined which banks score the highest. And so, you can see that of these metrics, anytime the bank is scoring above average, it gets a green, and it just a conditional formats. That's how I set it up. And then the scoring system auto calculates based on who's conditionally formatting to be above the thresholds and of outperformance. And so you can see that there's 1, 2, 3, 4, 5, 6, 7, 8, 9 banks that are scoring at least 6 out of 11 or higher. And you can see that there's 2 banks down here that are scoring 9 out of 11. So these 2 banks you'd absolutely have to take a look into. This one as well. There's a 9 over here. And then also take a look at the other ones that are scoring high. So it shortcuts the work for you a little bit. Now, note that just because the banks score high on these key performance indicator metrics, it doesn't necessarily mean that it's an investment worthy bank. You still have to understand why the bank scored so high and what levels of risk is inherent in their approach. For example, one bank that scored high has a huge reliance on wholesale borrowing, which means that in a higher interest rate environment, their profitability has collapsed. And that's just one particular situation. The bank also may have geographical or loan type or any other type of specific inherent risk in its business model. And so these are things you have to understand about your particular bank before you invest in the securities. And so let's pause right now and recap exactly what I just went through. I said first, one of the ways that I look for undervalued securities, I look at the S&P 500 52-week low list. I identify a potential theme. Then I start pursuing that theme. Does it make sense? And then I start looking at securities that line up with that thesis. So my thesis would be, in this situation, are some banks overcorrected in this environment, or have some banks' shares overcorrected? And really what it comes down to is I need to assess the viability and future profitability of many of these institutions, because we have a pervasive risk right now. And that's exactly what I did. And to give you another example, when it came to the home builders, what I actually did was I thought to myself, okay, these home building stocks are really low, because at the time, this was around 2 years ago, people were thinking that people are going to stop buying homes as interest rates went up. They were not wrong. People did slow down on buying homes. There was a pause period there. However, I thought to myself, okay, in what situation do home builders stock prices come back? Or in what situation, not necessarily the stock, I don't really care about the stock, I more care about the company. In what situation do the home builders continue to build homes? And I thought to myself, look, if home prices decline in a rising rate environment, I don't think people are going to be rushing to sell their homes because they locked in lower interest rates. So it's going to potentially take more inventory off the market, which it has. People are just not selling their homes right now. So what it does is home prices go down, or at least somewhat go down, or in real terms they go down. That's a different concept that you might have to take a look into. And so what ends up happening is home builders become more important because they're the only ones who are releasing supply into the market. And then add on top of that the fact that the US is underbuilt by 5 years, there was a greater likelihood than not that home builders would be more important for society going forward. And that was the thesis that I rolled through. And then I decided, okay, which areas would home builders be most important? Well, I looked at where the populations were moving. There was a lot of people moving south from the northeast because they could pick up cheaper property. Well, why was that? Well, because it was the post-COVID migration. We now have super commuters. We now have people that work from home, and they will continue to work from home permanently. And so you have a lot of people who are now brought into the housing market in areas where homes are a little bit cheaper to build and buy. So with that knowledge, I started looking at home builders that were building in these regions: Texas, Florida, Louisiana, etc., like all of the Carolinas, all of that area. And that's where I found Dream Finders Homes. And so it was easy to see that they were aligned with two parts of that thesis. One, that home builders will be more important, and they were. And the second part of that thesis was they were in that southern area. The third part of the thesis was just risk management. I didn't want to be with a home builder that had lots all over the country. I wanted to be with a home builder that had lots in a specific area, specifically the South, the areas that were growing the fastest. And so that's another reason why Dream Finders Homes really won. And so you guys saw the performance. Now, the question with the banks is, which banks are more likely than not to emerge from this downturn unscathed? And here's where I'm going to walk through one with you guys using the comps tracker that I built, and all the Patreons get access to this, by the way. And so, I would say, don't try and rebuild the comps tracker, or at least, if you want to save your time. I mean, if you want to learn, I would say build it for yourself. And if you have any questions on how to do that, I can definitely help you. So just leave a comment in the questions below, or leave a question in the comments below. But, I would say, rebuilding this chart for yourself could take weeks. It definitely took me weeks and to do. And so because you'd have to go through 5 years of financials for each of the 63 banks that I have on this list. And I really think that your time is more valuable than that. And so I've done the work for you, and the banking comps is available to you for you to use today at the higher tier of the Patreons. But just going through one particular bank. Now, full disclosure, I do own the bank, and I really, really like this bank. And I don't appreciate the heat that they've taken recently in the media, but it is what it is, right? And so, look at here. You can see that Bank OZIC has a score of 6 in the scoring system. And so Bank OZIC outperforms its peers in these 6 areas: net interest margin, the efficiency ratio, net charge-offs to loans average, the return on assets, tier 1 ratio, so they're well capitalized, and they've been increasing their book value per share at around 6.6% a year. So these are very important metrics where they're outperforming. In the areas where they're not outperforming, they're still doing well. Tangible ROE 14%, loans to deposit. I would say this is the weakest part of the bank. I would like to see loans to deposit around 80%. And so we'll see which direction this goes. I think that recently it's been trending in the up direction. So that is cause for a little bit of concern, not a material amount of concern, but just a little bit. Now, guys, scoring high on the comps tracker, which you saw Bank OZIC do right here, followed with a solid risk-averse market strategy, which what that would mean would be like they're not geographically concentrated, or they don't have loan concentration risk, or they're not in specific areas that have adverse risk right now. Like they're not super concentrated in hotel loans or office loans or anything like that. If they pass those two criteria, that doesn't necessarily mean that it warrants an investment. Not at all, because it still has to have an attractive valuation. And what do I mean by attractive valuation? Well, you can see on average, Bank OZIC makes a tangible return on equity of 13.9%. So call it 14%. Well, the company's currently trading at a price to book of 1.15 times earnings. So 13.9 divided by 1.15 gives you a 12.2% average tangible ROE divided by price to book. The 12.2 isn't bad, and that's based on the current share price. The this is the current share price, sorry, 38.56. The tangible book is 33.67. Now, going back to what I was saying, the 12.2 isn't bad. That's a pretty decent average annual return that you could get on the security. However, as I was analyzing these banks, I was getting really greedy. And so I was waiting for the average tangible return on equity divided by price to book to equal around 15%. And those were the banks that I was buying. And those were the banks that have significantly outperformed since May when I purchased those banks. The average return on this portfolio, on this specific thesis, has been over 25% now. Some of them are actually going back down. Bank Ozic is one of the ones that it's going back down. So I might actually double up on that particular one. Citizens is also starting to go back down a little bit, but the other ones have still remained higher, but they might also come back down as the consumer slows down and there's more of a risk in the economy as a whole. But overall, the point that I'm trying to get across to you guys is that the way to find these multi-baggers or potential multi-baggers is follow the thesis. So look at the one area is just look at the 52-week lows. You can identify theses. The other areas, I spend like $4 a month and I subscribe to the Wall Street Journal. In there, you can identify potential theses that come out as the news gets reported. And so, you can determine some sort of international thesis or whatever. But, once you find the thesis, follow the thesis forward and see if there's any potential opportunities or even opportunities that could even outperform the average company in that industry, like I showed you with Dreamfinders Homes. And so I'll leave it there for you guys. You guys let me know how you guys find potential multi-baggers, and I'll see you guys in the comments below. Take care, guys.